Well, thanks for taking in our webinar recording. So on September 12th, we had Stephen Lingard as a guest speaker. Basically, it was a discussion interview with Stephen on capital markets, portfolio design. So Stephen works in a space that is often referred to as active management. Active management's been a challenging sector to be involved in, and he actually gets into the reasons why. We've had a very interesting cycle for the last number of years where interest rates have been pushed down almost to zero, and we had seven stocks, basically seven companies dominating the S&P 500. But he makes a pretty compelling story for why active may become a very important part of your portfolio. Now, we historically, when you design portfolios, like to use a blending of strategies. So on the short end of the portfolio mix, we use cash equivalents, GICs, money market accounts to make sure we're very conservatively positioned to have income and liquidity available for retirement accounts. We have what we call a middle timeline, which is 4 to 7, 8 years, where we think active can play a really important role, because one of the biggest concerns is that clients want competitive returns, but they don't want to expose themselves to excessive market volatility. And then longer term, I think passive, whether it's individual stocks or ETFs, low-cost ETFs, can make a lot of sense. So I think you'll enjoy Stephen's discussion from the perspective of someone who works in the active space. He's going to talk a few facts about the current state of markets, what's driving markets right now, portfolio design, how active can play a role. So I think you enjoy this conversation. And if you don't want to miss future interviews or short-form videos on specific content, make sure you subscribe to our channel so you don't miss that content. As well, if you're within 5 years of retirement, make sure you get to our website. There's a link in the show notes to find out how you can get a complimentary retirement snapshot and gap analysis. Okay, let's get to the interview. Presentation today really will be kind of a conversation. We're just going to go through and talk about different aspects of investing and capital markets and portfolio solutions. And it's our real hope that you'll find the discussion today helpful. So first of all, Stephen, thank you so much for participating. Welcome.
Thank you, Shaun. Pleasure to be here.
Yeah, so it's great to have you participate. And I think before we get into the discussion today, can you just maybe share us just a high level how you got into the industry, and maybe high level your current role, kind of those experiences?
Sure, be happy to. I don't know how many decades I have to speak to here now. Unfortunately, we're knocking on 3 decades in this industry. I mean, it's good and bad, I guess.
Yeah.
And your seat, it's good to have someone with some experience.
Yeah.
In mine, it means yeah, I'm getting pretty old. But no, I've been at this for about 3 decades. I started off on the mortgage-backed securities desk at Scotia as an intern back in the early 90s, and really got a taste for macro. It was something that really got me up in the morning, got me excited, and I've carried that through till today. Obviously, over the years, I've spent time on the sell side, but more recently on the buy side. Spent time in Europe and Asia, and US as well as Canada, and kind of rounded out that asset class expertise, starting in fixed income, focused on equities, and then obviously brought it all back together with a kind of a multi-asset focus. And I've been in this kind of current role with CI for a little over 5 years. Prior to that, I was with a big West Coast-based US money manager in a similar role, sort of running or co-heading multi-asset strategies for CI today. Yeah, that's the background.
So a real breadth and depth of experience over the years. And how long have you been now with CI? How long has that experience been?
Just a little over 5.5 years.
Okay,
Yeah.
perfect.
Yeah.
So I guess what I'd like to hear from you, this will give some people some context for our discussion today, is maybe you can just share a little bit about your current role, how you see your kind of key responsibilities within CI Global Asset Management now.
Sure, and it's a really interesting time. I'm glad you asked the question. We've been transitioning. I think we've arrived in many regards as full globally capable asset manager. For me, as co-head of multi-asset with Alfred, really my focus over the last many years has been to really institutionalize our process when it comes to research, on the multi-asset side. We've built out a team of research analysts. We've added depth to our portfolio management and trading capabilities, and really sort of enhance the resources to deliver an institutional quality experience to investors. It was what my background was, and so I think that's really been kind of a big focus for me in my last couple of decades. And that was really the opportunity to come over to CI. I probably managed about 4 times the assets that I was managing at my previous firm. Even though the previous firm was a much bigger global organization, the success that I saw of CI in the Canadian marketplace, in particular through our wealth management business, meant that this is a large pool of assets that really needed institutional quality investment management. And happy to go into more of what that looks like today, but
Yeah.
yeah, I'm really pleased to be here with Alfred, heading a team of 7 investment professionals, and I would say a much broader, much more integration with the rest of the firm. If you think about, maybe the first 3 years, I was really building out research and portfolio construction. I'd say the last year or two, I've been really trying to sort of integrate with the rest of CI GAM. There are other macro thinkers who I very much respect and have, great insights on their asset classes. So I think the benefit of increased conversation, increased engagement across the different investment groups is continuing to this day and will only get stronger.
Oh, good. Perfect. That's very helpful. So when um, I try to give folks a perspective on things, and my description here about your role may not be completely accurate. So you just stop me as I go through it. But often when I've heard you talk, we sort of have, it's not all the themes, but two main themes that emerge would be the macro, so the sort of high level, and then the bottom up, really the stock pickers. And I know that you've got an interesting role or relationship between those two areas where you take the macro perspective, the top down, and then try to integrate the bottom up, the stock pickers. Are you able to share just a few comments about that relationship and how it kind of interacts with each other?
I do, and if you don't mind, this might be a good time to go to the deck, just
Sure,
because,
perfect.
and then I can jump off it afterwards. But I think I've got a decent slide. It should say investment philosophy. I think I'm seeing it there on the second screen. So
Yeah.
yes, I mean, it is important to say, okay, what do we do in multi-asset? And what I would say is that we really try to underwrite the risks in portfolios that are most overseen by us. What does that mean? We're not stock pickers. We're not bond pickers. We think about risks more at the asset allocation level. So, what kind of portfolio construction, how we see equities, how we see regional equities and different equity markets, how we see factors, sectors, how we see fixed income, commodities, different FX. So, it's much more of a top-down, high-level framework. So, if you think about an investment portfolio as you see here today. So that could be a 60-40 portfolio. There's a certain amount that is attributable to beta, which is really just what is the exposure to different asset classes to achieve that, say, 6% annualized return over a full market cycle. So obviously that's not, we've done better than that over the last 12 months. We're probably like 12 or 13%, but really over the full length of a cycle, 60 portfolio, 6-7% is kind of, your target. A lot of that is driven by exposure to equities and different equity markets and different fixed income and different asset classes. But how we vary the portfolio is really over to this, Greek term called alpha. And really what that means is, are you beating the benchmarks that you set for yourself? And then how do you go about varying from those benchmarks? So again, if the benchmark's going to achieve 6%, how can we achieve 7, 8, 9% in portfolios? And that's really the order of magnitude. We're not a hedge fund. We're not looking to beat the market by 20% on a given, in a given year. It really, these are pension style portfolios. So it's incremental risk where we see opportunities. So again, getting back to that portfolio. So if you have your structural portfolio, then we're thinking about, well, how do we vary these different things, with regards to asset mix, the mix of stocks, bonds, cash, commodities, how much domestic equities versus US and emerging markets, Do we like credit relative to government rates? Do we want to be more hedged because we have a positive view on the Canadian dollar? All of these types of things are what we classify as macro alpha, and you see that bucket in the middle. So this is how we set up portfolios to capture some of those macro factors. That is completely separate. And last but not least, to the micro alpha. So really, the micro alpha is really your bottom up security selection. We, as I said, are not stock pickers or bond pickers. So we partner with good underlying managers and portfolio managers, both internally and externally, in addition to ETFs. And we can go into a conversation there because there's been a big boom in ETFs. They're not just passive instruments. In fact, most of the market launches recently have been some kind of more smart beta or algorithmic type active strategies. But so we have a lot of a big opportunity set on that side. So that's how we kind of combine it. We've got the structural beta component. We have kind of the asset allocation that we think about and the ways that we vary the portfolio to create a certain profile to take advantage of opportunities that we see to insulate the portfolio from market risks that we see as likely. But then there's also this other component, which is really the stock and bond picking. Again, we're not experts, but we outsource that. So I see my job really as a risk manager. You can measure risk. You can't really, sorry, you can manage risk. It's more easy to manage risk than it is manage return. And then that return is really a byproduct of a well-constructed portfolio. So that's how all the kind of components come together. Maybe I'll stop there just to make sure that was clear.
No, that was good. So I think for people watching, what's great about this visual is when we have retirement portfolios, particularly, we sort of try to divide the portfolios into three timelines often. So we have the short duration, which is for more immediate income and liquidity needs. But then we have this middle term where we're really trying to manage risk. The durations aren't as long, but the client still wants to get, competitive returns. And this is where this extra layer of management can come in handy. So maybe give me an example of putting you on the spot here, but if you
Sure.
said, okay, I'm looking at the different regional allocations. Do you have an example of, trigger points when you're looking at the portfolio from a macro standpoint that could trigger a change in position about your allocation, let's say between Canada and the US or Canada and, international? Are there things that you're looking for in your model that could trigger some adjustments to that mix
Yes.
geographically?
Yeah, that's a great, thank you for that opportunity to highlight an example because I think you really get into the details, you start to understand, where we spend our time. So we have three macro and investment analysts. And one of those individuals is working closely with me on equity. So the way that we've kind of divided up the workload, so to speak, within our investment committee, Alfred does a lot of work on cross assets. So that's really that first bucket, which is asset class. How do stocks look versus government bonds versus credit, cash, commodities? So we can vary the portfolio to sort of capture our relative outlooks on those different sectors. I used to do that. I can do that. I do that as well. But if we're all generalists, then we're all doing these areas not very deep. So what we've chosen to do is he really spends all his time on that. I don't worry about that. I kind of default to him on driving that research. Still ask questions. He's not the only one, obviously, that sets that, just like I'm not the only one that sets equity strategy. But each of the senior PMs that on the team are responsible for research delving into these areas. So I'm the equity person. So if we've had that sort of investment committee meeting where we've said, right, we want to go neutral on stocks as we've done more recently, buy back bonds a little bit, still carry a cash overweight, we're overweight credit, a little bit of exposure to commodities. How do we invest in that equity component? That's really up to me to sort of make recommendations on. So the way that we think about the world is, and I tallied this up recently, it's about 37 different equity investment opportunities. So we look at 17 different country equity markets on a top-down basis. So that's Canada, that's the US, that's Japan, that's UK, separate from Eurozone. We look at Australia, we look at China, India. Brazil, all of these independently. And we have top-down targets, and that helps us understand, okay, if the return opportunity is very, very large as it might be in emerging markets, because valuation is low and earnings are starting to deliver, then that target will suggest to us at least to bring the idea of overweighting a certain asset class. In the case of the US, and valuations are very difficult because you could have said this about the US a year ago. The US is expensive. Um, so one of the hands, there's two things really that drive equity returns. That's the cash flow, in a lot of cases through dividends, earnings, and then obviously the price that you pay, so the valuation component. So when the valuation component is really at a maximum, it really makes the return profile dependent on the cash flow and the earnings. And I think that is good. There's no question the U.S. economy is in good shape. Looks like maybe we're able to engineer a soft landing. But I'd rather, in some cases, have markets that can give me both earnings growth and the possibility of valuation expansion. So U.S. Is a slight underweight because it doesn't have kind of both factors contributing. The AI story is undeniable. There are great companies in the U.S. That Magnificent Seven that we've seen is still delivering earnings growth around 18 to 20%. Now that's down from 30%, but so it is slowing,
Mhm.
but it's still a good story. It just doesn't have that other kicker. So that's an example today. I would say, we're slightly in favor of those markets that could benefit from a cyclical upturn if we get a soft landing. As central banks around the world begin to cut interest rates, if we can engineer that, I think the U.S. dollar goes weaker, which will tend to help out non-US markets. But it's not a significant, I would say, contribution to risk in portfolios, but at the margin, yeah, we're favoring non-US markets. And I didn't mention the other things. We do look at sectors, and we do look at 11 of those, the GIC sectors, to try to understand, where we are in the business cycle, which sectors are more likely to outperform given our view of the macroeconomic environment. And then finally, we do the same thing with factors. So we do think about growth and value. It's all that anyone thinks about. I think we think about low volatility, dividends, small size, and other things like that. So it's a big job. We have a number of different sort of metrics that we look at, but we bring in that research and then we have a discussion about them. And ultimately, those recommendations hopefully will, when there's conviction, make their way into portfolios, and that's how we'll structure.
No, that's helpful. So for folks watching this, you're trying to, connect the dots here based on what Stephen has suggested. So you got the box under macro alpha when you're watching the screen here. You've got the asset class. So let's say we're talking right now about equities. There's a member of the team, Alfred, that is quite involved in that allocation of different assets to build the mix. Let's say your team has a perspective. Let's kind of underweight US a little bit, overweight global. And then if we go to the sector piece, are we going to be more defensive because we think there might be a little more of a slowdown or a slower, sluggish economy? What stocks would do well? And then once all that work is done, you're then working with the micro alpha, the far right corner, and you're hiring folks where you're saying, we want you to buy securities, individual stocks as an example, to be consistent with our view at a macro level. Is that a good summary of
I,
the
I
answer?
would I would tweak it a little bit. At the end of the day, we're not that prescriptive. I would say what we do is we actually start. Let's just say we actually start with the manager side. We have a manager set that we think will add value, risk-adjusted return alpha over a full market cycle. But then, yes, the weighting decisions may then sort of factor into our top-down approach. So let's say we don't
Okay.
like technology, which we still like technology, but if we had to underweight a sector, we think it's one of those higher price sectors, that could be vulnerable, certainly in a hard landing, but even in a reacceleration. We think some of the other cyclical sectors might do a bit better. We would, generally look for managers that are maybe a little bit more conservatively positioned in technology. But it is a subtle distinction from the way that you put it. We hire good managers in the core asset classes that we allocate to. So let's say US equities, for example, we would have kind of a more growth-oriented investor, a more value-oriented investor, and maybe a core investor
Yeah.
or fund, let's say. So the US equity suite might make up three or four or five funds even. And yes, across those four or five funds, which are all good full cycle funds, we would prefer those that more align with our top-down view. But instead of, as you suggested, we'd be looking at just building individual sectors or individual factors. And generally, we have generalists in these equity asset classes. So they're core US equity managers with a particular personality tilt. But we would then, and we think, first of all, they're good long cycle managers. We would then just massage their weightings based on that top-down view. That's how I just sort of tweak your comment.
Okay. Okay, perfect. That's very helpful. Well, maybe we could leave this slide for a moment, and I just want to introduce, maybe as a group discussion, a question. I think that slide is a really good introduction to a question that comes up. When we construct portfolios, we actually have a combination of cash equivalents, active, and some passive ETF strategies on portfolios. One of the questions that comes up sometimes is the whole notion of, do all those moving parts you just talked about, do they in fact add value? And if they do in fact add value, in what areas can an active strategy like this really play an important role for investors? And if you do talk about passive, does passive play a role? And if so, where? So maybe you can educate us a little bit about, the active passive debate and how that kind of gets framed sometimes.
Sure, absolutely. I mean, obviously, the interest in passive has been tremendous. That has been in part because active strategies really have struggled over the last 10 years. Not all, but it's been a more difficult macro environment for active bond selection, active equity selection, to overperform. So I think, but that's in the past, right?
Yeah.
That's very consistent with a low economic volatility environment when you have interest rates at zero and no inflation, no economic volatility, no financial market volatility, no opportunity for prices to be pushed beyond their fair values, wildly so. So you get interesting opportunities because as an active manager, you want volatility. There's been a real absence of volatility, I would say, over the last decade. And that has really been why passive strategy has done really well. I think best exemplified by the fact that, I think less than 5% of US equity managers have beaten the S&P over the last 5 years. I expect that will definitely flip over the next 5 years. I can't say that, as an absolute promise, but capital is really um, managed inefficiency when it's just drawn into the stocks that win. So bigger stocks get bigger, their valuation gets poorer, even as potentially their fundamentals turn. It's a poor way to allocate capital. There is a place for passive, obviously, because it's hugely deep and liquid. So as we think about moving our asset allocation around, we would much prefer to do that in large liquid momentum stocks, which really is what the large passive equity indices are, for example, within a lot of the different markets. The other thing I'll say is, so when interest rates are zero, that's a tough environment for active managers. But historically, as interest rates have risen, that has created that economic volatility. So we could go into we could get a reacceleration. We could go into recession. There's two-sided pricing to bonds. There's two-sided pricing to equities. It creates a more fertile environment for active managers, and we've even seen that in the last 12 months.
Yeah.
You've actually seen active managers begin to significantly outperform passive benchmarks. And maybe the example best to use there is it's been easy to beat the bond index over the last 5 years. TLT, which is long duration US government bonds, is down, I think, about 40% from its peak in 2021. So to the extent that you owned a 2-year bond, a 5-year bond, or a 10-year bond, or kept your duration short, you had massive outperformance versus that anchor, which was long bonds that were trading on a negative real rate, which didn't make sense. It made sense only in a financial repression environment when the Fed is pinning interest rates below where they should be otherwise. So again, I think those are a couple examples why we see a great opportunity for active on a go-forward basis, whether you're looking at stocks or bonds. And again, the key ingredients in that is a normalized interest rate environment. Yes, interest rates are probably coming down now, but they're not pinned to zero. That's not a normal environment. And inflation is now back towards sort of its 2% target. It may even stay a little bit higher. So that's definitely going to create a little bit more volatility, more opportunities for active managers. And again, we've begun to see that. And we do have a range of different portfolios. So I know I'm not here to talk portfolio specific necessarily today, but we do have the Mosaic range that's 100% ETFs, and we can talk to you and folks on the phone on how we try to engineer that active share, which means how do you look different than the benchmark through either asset mix changes or country changes or factor changes or individual stock mismatches versus the benchmark. But then we also have a range of solutions that use a lot less ETFs and a lot more active strategies, whether they be pools or funds. So again, we have a full range for clients based on that sort of that whole spectrum of lower cost investor, modest costs, and then full blown active strategies that do come at a little higher price point.
So that's helpful. And I think we always have to be reminded, although we don't like it, historically, active managers make money for clients by exploiting that short-term risk and volatility. And we've gone through, like you said, a long period of time when interest rates were pushed down almost zero. And it's actually created some dysfunction in the markets, dysfunction in the economy to a certain extent. We get asset bubbles because the regular mechanisms maybe don't work the way they should. So it's probably an argument as well because it's hard to know when those transitions are going to happen. So I think having the two strategies in play can probably make sense as well in terms of how you build portfolios. So let's use that as a bit of a segue. You've kind of been alluding to this a little bit in some of the discussion, but if I had to ask you, when you look at active and where it's going to add value to portfolios at a practical level for retail investors trying to manage their retirement portfolios, what are your thoughts on that? Like, where are you excited about the use of active in portfolio design?
Yeah, so on the active side, I mean, the one thing I'll just differentiate is we can hold passive ETFs, but if we're very nimble with them, we would consider that active management. But
Right.
on the underlying building block, yes, we've been allocating a lot more to strategies that are not market cap weighted. So, simple example in Mosaic, we're invested in the Russell 1000 as opposed to the S&P 500 to sort of get a little more diversification away from those Mag 7 stocks.
So
Um,
Stephen, you just
yep,
kind of answered the question I was going to ask you just now. But if you sort of market cap weight, can you just define that for the people on this webinar, and
sure,
then why you would use Russell as an alternative? Because there
sure.
might be a little bit of loss of
Yeah, I
understanding.
know that we're famous for making in the industry making using jargon. So every night when you're watching your financial news, generally the S&P is quoted or the Dow is quoted, the TSX comp is quoted. These are broad market averages that include a whole host of underlying stocks. And the only way that those indexes are created is just the simple uh, underlying market cap from each of those stocks. There's no adjustment made. If you include it in the TSX, we can use as an example. Shopify is whatever $1 billion company. It goes into the index. It ends up being 4.5 or 5% of the TSX. Nvidia, to use a very popular example, is probably a 5.5% stock in the US, close to Microsoft and Apple that are 6 and 7%. So market cap weighted means, and that was what I was kind of getting at earlier, those are very momentum driven. So as the valuation of an individual company goes up, that individual company gets more and more weight in the portfolio. So if you're saying, geez, I have a lot of interest in small capitalization stocks because here's a great business and they're growing, their earnings and cash flow and they're trading very, very low multiple. Well, you wouldn't access that by buying the S&P because the actual exposure to small caps in the S&P is minimal, right? So So hopefully that helps. Market cap
Yeah.
weighting really is what passive investing is, and it is very momentum driven, and it's worked for a long time, and it ends up being cheap. So that's kind of, but that was again where we were when we went from sort of 5, 6% overnight interest rates down to zero. That favors market cap weighted and passive strategies, so index strategies. On the way up, now that we're normalizing as rates back off of zero, we would prefer to not look like the indices, not be market cap weighted, to employ active strategies, both within equities and fixed income.
Okay, perfect. That's helpful. So um, I'm talking to a client and their preferences. I just want to throw my money in VBAL or like I said, one of Vanguard's S&P 500 index ETFs, and we're building a portfolio. What would you say to that investor as it relates to including active as part of the strategy? What's going to be the potential win of going down that path?
Well, I think I might point out some of the pitfalls first to get that individual interested in looking at maybe an alternative way to invest. Because if you look at, and I'm not saying any particular strategy, but those market cap weighted all in one strategies, they're huge momentum trades, right? So if you look at, if you invested, let's just say in a 60-40 fund and you had 40% in the FTSE universe over the last 5 years, you've gotten almost no return because that had a very long duration component to it. Actively, our portfolios, that's where the biggest source of value add we've had versus our indices, and hopefully we might get an opportunity and just highlight a couple of the strategies. But that's probably one of our biggest value adds was win by not losing in the fixed income space. We had first of all, we were significantly underweighted those strategies, and we had a very short duration posture within fixed income. So when that huge rate sell-off that we saw over the last 3 years from 2021, I mentioned that particular ETF TLT, which lost 40% of its market value. We largely sidestepped that sort of bloodbath in the fixed income market. So that's I think that passive strategies today, if you're buying them, you're hoping for more of the same, and that is long duration strategies work. Secular growth works. US continues to outperform the rest of the world. If that's your view, then at the margin, passive strategies are likely going to continue to work. If you have a view of the world like we do, that we're in a normalization, doesn't yes, rates are going down, but they've moved up, and we have much more of a normal interest rate environment than we've had in the last ever since the financial crisis, frankly. Um, that is likely to favor strategies that are not momentum based. Even value may come back as a strategy if inflation picks up. We're seeing, gold work really well in portfolios. So I think that we are definitely trying to think about active share that we do measure versus our benchmarks. Because I should say our benchmarks are um, passive market cap weighted. So when we look at our portfolios relative to those benchmarks, we want to make sure that we have that sort of active view incorporated in a bunch of different areas so that it's not just one singular sort of view on say stocks versus bonds or domestic versus foreign or credit versus rates. So that's really how we blend, the passive. So passive do still play a role. Again, they're good for liquidity, trading in and out of positions when we want to go long one market or reduce another market. But increasingly, and I'm sorry I don't have the chart to show you, but definitely could follow up with you, Shaun, after. It shows that our Mosaic ETF portfolio, we've been very deliberate about getting up the number of active ETFs in the portfolio to the point where we only have about less than 30% of the ETFs in Mosaic are passive. So we have fully 70% that are either actively managed or smart beta strategies, which is really just rule-based active, is really how I think about it. So we've been very deliberate in taking up our stock selection, active share, i.e. picking different stocks and bonds than our underlying indices through use of active ETF strategies. And
Yeah.
then obviously on the fund side, that's the bread and butter for individual funds and pools. Those are active. They don't care about the index in a lot of cases. They care about picking good stocks, sectors, bonds, etc., to achieve good returns for clients. And we're leaning on that side of the house more than we are passive.
Yeah, that's a great overview because I think your one comment, which you always have to remember, is you win by not losing. And I think that when it comes to active, you don't see the value sometimes of active until you see these cataclysmic events. And then you go, okay, now I understand why focusing on valuations or active strategies plays a role. There's almost it's crossed negative correlation between the broad market weight, drivers and then what an active strategy is trying to do. And then you're finally vindicated that, okay, we were able to protect on the downside and then exploit the upside. And they don't run parallel to one another. They're not directly correlated, they're negatively correlated. And so that's the challenge because I'll get questions. Well, compare my passive strategy to my active strategy. And it's like, well, you can't really compare because they're different animals in some ways. And the active is getting ready for opportunities. And it's not until those opportunities emerge that you can really realize them. Um,
Yeah, in
so
a lot of cases, you're positioning for that big drawdown. So there's an asymmetric risk there.
yeah,
So I'd absolutely say it's tough. Like in our business and your business, obviously, is keeping clients sort of engaged in the idea that active is really valuable, because it's over very quickly, in the case of that big bond route, before you can even sort of reposition portfolio. So it is a tough sell to say to clients, an environment where I can save, you're going to have your cake and eat it too, essentially has been the environment. You got a lower cost passive product. Oh, and by the way, in many different asset classes, it's also outperformed. But I think increasingly we're seeing that that isn't the case anymore. And, all else equal, you should probably invest more in active management through fees, to get what's coming, which is I think a very different market than we've had in the past of zero interest rates, because that definitely favored certain long duration assets, secular growth, and things like that. If anyone has a value manager out there, you're probably lucky because a lot of them have been shuttered. But I have no doubt that the value investing, as an example, will come back in the next market cycle that we have. We've seen fits and starts this year, but the same
yeah.
goes for other styles that aren't growth. Growth has really been the dominant style, but that will change.
So I just want to remind everyone, not everyone came on the call right at the beginning. So at the bottom of your screen, I think it will be at the bottom of the screen for most people, there is a Q&A button, kind of left to center. If you have any questions, don't hesitate to ask your questions, and then at the end of the presentation conversation, we'll try to address those questions for you. So when it comes to this discussion that we've just had on active and passive strategies, would I be putting you on the spot if I asked you, I said, because you've alluded to it right now, like a few times. So we're transitioning potentially in a different investment environment. Are you able to give everyone on the webinar a sense, from your perspective, what are those differences? Like what things are we moving into? And I think you've shared a few already, but if you had to kind of give us a little bit of a laundry list of this is why active, whether it's interest rates or valuations, or what are the key drivers you think will lead to the active strategy being a really appropriate choice for portfolios?
Right. And part of it has been like we've been positioned pretty aggressively out of the bond market. I mean, we are seeing more value in the bond market as real yields become more positive. So, they've run really fast over the last 6 weeks, I'd say. Bond yields are down 20, 25 beeps, so less value today, and probably, taking profits in those and adding more back to cash. I would say, so on the cross asset basis, bonds are really discounting a recession, and commodities are probably discounting recession. Credit and equities are not. So to the extent that we get a soft landing and or no landing, I think bond markets, definitely, could be in trouble. As rates probably have to readjust higher. So, there are some active opportunities on a macro basis. Within equities, we're not taking significant risk, but we are rebalancing into some of the strategies that have underperformed. So things like low volatility, value strategies, having some exposure to small caps. That's actually hard to do because if you're looking in the rearview mirror, these are all very poor areas. And why didn't you just own the Mag 7? But as we saw in August, we were in a bear market in Nvidia before finished the week. So there can be some really volatile patterns in markets. So you want to make sure, firstly, you have diversification to multiple styles. So if you learn or take away anything from this presentation, we're never all in on any particular asset class, any particular region, any particular factor or sector. These are all well diversified portfolios across all of those different metrics. But yes, at different points in the market cycle, we will over allocate capital to a particular area based on our outlook. I would say within equities, just to give you more my lens, we're actually much more neutral. We definitely want to still take active share versus the underlying indices, but if you look at regionally speaking, we have a slight overweight to emerging markets. It's kind of, if it was ex-China, it's probably been working. But given EM still includes 25% in China, and that's been difficult, it really hasn't added a ton of value so far this year. But allocating to different managers and different smart beta products that have had less exposure, let's say, to this correction that we've had in the Mag 7 has added value to portfolios. So, between 70, 75 and say 100 basis points sort of year to date, better than those market cap weighted indices. So we're probably seeing a lot of portfolios up, around 9 or 10% versus sort of 8 or 9 for the benchmark. So that's kind of the order of magnitude that we try to achieve too. Again, in let's say a 9%, benchmark environment, we're not trying to do 18. That would be taking far too much risk relative to, what the average investor would expect in each of these strategies.
I think it's a really good point, is that you get back to one of your initial comments, was we're almost like a pension style philosophy. What you're trying to do is titrate risk to have a very consistent return over time, to hit those target returns that we're shooting for, to at a very practical level, funding retirement income, funding the plan. What kind of total return do we need to get from a portfolio to do that? And most of our clients do not want to take on more risk than is necessary to drive those returns.
That's a great point. I should have had that slide ready for you. I don't, but again, I could follow up with that one as well. And basically, it really shows the frontier. It shows achieved returns. And really, despite all the volatility, we've seen the best and the worst of times really in the last 6 years track record of Mosaic, and yet we're probably at or above our sort of suggested target on day one. So it's a great point that you make around that pension style and kind of delivering on expectations. And we want that too, to the extent that we can minimize risk but hit that return target. I think it helps you in your seat and conversations with your clients. And it helps, I think, develop the profile of these, or personality, as I call them, of these individual strategies. So it matches what the risk tolerance is on your side.
Now, did you have some examples from the slides that you had prepared? I think you alluded to the fact that you've got some solution examples of how you structure portfolios to seize opportunity. If I got that right, is there some pieces you wanted to show us on the?
Let me just take a look through here. I had some macro slides. I had, kind of some attribution, but no, the slide that I was hoping to highlight, this is a really important one. I want to talk about this one for sure. Just trying to see if I have it here. I probably don't, but I could definitely provide that as a follow-up.
Okay.
Apologies.
No problem. Any slides there that you thought might be good illustrations for folks on the call around some of the themes that you had mentioned on the economy or the macro perspective?
Sure. I think it's all been about inflation. So obviously inflation is headed in the right direction. We should all be happy that we're not seeing 9% inflation. I know it's still difficult out there. And that, is a result of, yes, the year on year has gone down to a, let's say, manageable level, but you had a stepwise increase in foodstuffs and energy and utilities and interest rates, mortgage expense. that's pretty difficult. So I'm not here to say that, inflation is slayed and we go, marching onwards. That huge, blip that you can hopefully see here, it's good that that's in the rearview mirror, but we're still talking about price gains in the order of 3% a year, which is above the Fed's target. It's a little bit better that with the Bank of Canada, but broadly speaking, the market is anchored on the fact that inflation is heading back down to target. Now, I personally believe that we could plateau somewhere in and around here. So it may even be a bit premature for the Fed to cut aggressively. I still think they should cut because ultimately the real rate, which is the nominal rate less inflation, is quite restrictive. When you're at 4.25% and you have 3% inflation, you're talking about 2.25% real rates, which is restrictive, and we should expect the economy slowing. So yes, interest rates should come, but I'm not sure that we're totally out of the woods on inflation. But I do think you can get some maintenance rate cuts, as we've seen in the Bank of Canada, and we're likely to see, later this week or next for the Fed. So inflation is a good story, and you see a lot of that is goods based. So on the right-hand side, that blue chart highlights that, when we snarl supply chains and shut the global economy down, well, guess what? There's price increases when you reopen and you buy stuff, whether it be, multiple Pelotons or ordering, multiple semiconductor chips. There was a real, seize up in the global economy. So that pushed prices. So a lot of that has flowed through now to the point where goods prices are actually disinflationary. They're negatively, they're actually bringing down prices year on year. And that's why they're below that line at zero. But we still have shelter prices that are pretty elevated and sticky. And we have supercore, which is this idea that Fed Powell sort of used lexicon again, but it's this, there's 50 different line items in the CPI basket. So what it says is, okay, goods is, 10 or 12 of those. Services is, a bunch of those. If you look at shelter as one of the biggest services, and it's such a huge component of CPI, they look at it independently. You can begin to get an idea on, okay, well, what is going to help overall inflation either up or down? So it's just a way to group different components of the CPI basket. But bottom line is, it is heading towards target. So the Fed has basically said, we're now going to focus on growth. And a lot of that is, well, you can look at economic growth, but their other mandate is the labor market. So they're likely to cut interest rates and probably a few more times over the next 6 months. Probably don't want to be political and do a whole bunch right before November, which will be very interesting. Get your popcorn ready. But overall, if they've really solved the inflation part of their mandate, and again, I have a question whether they have, and they focus on the growth side of their mandate, that's why they're thinking about cutting interest rates to make sure they shore up the labor market. You saw big downward revisions in payrolls. So clearly the labor market is weaker than we otherwise thought. So it is likely to bring some of these rate cuts. So that's some of the key, inflation heading back to trend. Let's see if we can stick this soft landing by a couple of rate cuts this year. And that's really just normalizing a monetary policy in this environment. The one thing I'd like to point out, though, and this is why, I'm a little bit leery of sounding the all clear on inflation, is it doesn't matter whether we get Harris or Trump, you're likely to see budget deficits far into the future. And that could have an impact because historically speaking, you expand your budgets to significantly and spend a lot when you have a weak economic growth environment. We've spent a lot and run big budget deficits in Canada, the US, Europe. A lot of that was, well, because of COVID. And that was certainly allowable, right? But we're still running them now, well after COVID. And so you're thinking, okay, where's the firepower come from? So that might be, stimulating excess demand that makes sure that, maybe inflation doesn't get down to target. So while I talk about normalization in everything, the one area that we don't see normalization on is fiscal policy, no matter where you look around the world, except maybe China. You're seeing expansive fiscal policy, i.e., individuals, whether you're Republican or Democrats, you're not balancing the budget. And that does have an implication for demand and potentially inflation. So that's the one area I would say. Maybe this is the takeaway slide for us. I've been talking all year about how this is not a repeat of 2022. So many people have asked me over the last year, is a 60-40 portfolio dead? It was such a disaster. Like, you probably did better in 100% Canadian equities than you did in a 60-40 portfolio in 2022 because you maybe, held less equities, but then own bonds, right? So you're jumping out of the frying pan into the fire. What I've been saying for all of this year is that this notion of equity risk premiums, really important. Basically, this is a relative valuation gauge between stocks and bonds. When these lines are really, really high, you're getting paid to take equity risk, not bond risk. And when they're really, really low, you're starting to be paid pretty handsomely for bond risk, not equity risk. So this isn't to say, hey, buy bonds or buy equities. But now that we've normalized this equity risk premium, it means it's kind of a push. You're getting paid to own both. So depending on your cyclical outlook, maybe you tilt a little bit. And I think this helps explain why we're back to, very much closer home when it comes to a 60-40 portfolio. We've just reduced equities now down to about 60%. We bought some more bonds. We're still underweight there, but ultimately you're getting paid to take both of these very different risks. And this line really is the spread between, just think about it as the yield or total return you'd get on equities, subtract the yield you'd get on bonds or bills, and effectively that's zero right now. So it doesn't have to stay at zero, as this chart shows. You can have periods where equities are hated. Like, you think back to 2008, you were getting paid an 8% risk premium to own equities because people were so scared because of the financial crisis. They didn't want to hold equities at any level. Well, that obviously was a great trade to step into that and own some of that, period where markets were really upset. All this to say is that, balanced portfolios have really done well this year, up 9-10%. They're up, close to 14-15% over a trailing 12-month basis. So we've had contributions, obviously, from equities, but also bonds in this environment. And that's the first time we've really seen that in a few years.
Yeah. Just going back to the inflation question, I have a question for you, and that is more the rate of growth, the rate of inflation, of course, is decelerating. But like you said, prices are still high. I mean, we're at sort of new levels in terms of prices. Do you see a normalization of prices? I know it's a confluence of labor, supply chains, the economy. But are we kind of at a new normal in terms of the pricing floor? We're not likely to see much of a change. We're just now at a new normal for people's experiences around costs for things, or what could drive lower costs overall in the future?
I think it's interesting to think about. Like, we are, obviously mostly, I'm sure all Canadians on this call, you've seen some pockets of telecom. Like, my mobile bill has gone down 30%, but that's, probably the only thing out of my basket that has really gone lower. So I think this is an opportunity for corporates, all else equal, to take, their margins up, because people are used to, first of all, they're getting paid more, right? So wages are growing up at least as fast as inflation. In many ways, it's actually above inflation now. Now, are they behind? Like, did that happen a year later that so their basket of goods went up by 20%, and but then year on year, inflation had fallen to 5%, so they got an 8% wage. So in real terms, they're still well behind, but on a year-on-year basis, they're actually making gains towards, catching up. I would say that a lot of companies still want to push through prices now that investors or individual consumers are used to prices, going higher, not lower. So I actually think we're in a period where, let's say, at least normal, and normal isn't 0% or 0.5% or 1%. It's really, if you look at the U.S. economy over the last 100 years, there's good data on this. 3% is actually the long-term average for inflation. So this construct of 2% is actually below where inflation has actually historically been. So I'm not saying that inflation really surprises to the upside, but relative to recent years, I think 3% is much more of a normal sort of inflation expectation. So no, I don't really see, unless we go into a hard global landing, clearly you're going to see inflation sink. You're going to see prices go down, as individual companies try to rebuild market share and then worry about profitability down the line. So if we don't get that, I don't see prices easing much beyond. I think the way to look at it maybe is 2% is now a floor instead of a target.
Yeah. Okay.
And we have a researcher that we use that speaks a lot to that. So unfortunately, I don't think so. But hopefully wages keep up.
Exactly. That's going to be, we have policies that grow the economy and grow wages and grow. That's how you get yourself into a better situation. We have no questions by people participating. So that's why I've kind of stretched our discussion here. We're now got 5 minutes left. So I'm going to give you an opportunity. Stephen, is there anything that you had wanted to kind of share with us that you haven't? Any final comments for our discussion today?
Sure. I don't want to get too technical here, but I did have just a visual that kind of highlights that, value add from active management. So if you'll give me a second here, it's just this slide. It kind of highlights. Maybe we'll go to we can go to this one here. It's probably good contributions from both. So, again, this is how we kind of measure how we've done. We've been overweight equities. That's generally been a good decision. It's added about 10 basis points of allocation effect, or 0.1 of 1%. We've been very underweight fixed income, which added 70 basis points. As I referenced, that was one of the biggest contributions to the overall return, sidestepping that fixed income market. As you can see, that 60/40 portfolio, we should have been 40%. We were down at 31%. And that, unfortunately, I didn't show returns here, but returns have been, fairly flat to negative, where they've been quite positive, obviously, as we know on the equity side. And then within different regions, this is a little bit, we've been underweight the US, but not this much. I will say that it's a bit of a flaw in this report. We've probably been about 18%, but because we own US in, say, Canadian strategies or international strategies and global strategies on a dedicated basis, we did hold less US. And you can see that actually detracted 60 basis points. But when you add all of this up, the allocation to private alternatives added 40 basis points. And then you look at, and that's just from that macro alpha piece. If you look at the manager selection piece, did we pick good managers? Well, we also did pretty well there. Really on the strength of Monroe Global Growth Equity Fund. It outperformed its growth equity benchmark by, I think, about 15% year to date. It had a double weight to exposure to NVIDIA, as well as a number of semiconductor and climate-related companies that have done exceptionally well. So again, talking about, we try to do the macro asset allocation. We've done a decent job this year, adding 100 basis points, 113, I guess, year to date. But equally, then we've also assembled a good list of managers, and they haven't all been positive, but when you net them all out, more good than bad. So we've actually had contributions from both that macro alpha, that asset allocation alpha, as well as the underlying stock and bond pickers doing a really good job. And you can see two of those bond pickers, both within, in the second and third spot in terms of the contributors on the manager effect, 17 basis points each, which is that's a big number when it comes to bonds. When you talk about 35 basis points out of the overall, say, 113 basis points, that's a significant contribution from bond managers, because bonds, remember, are not very volatile. So to get that kind of active performance is pretty strong. So, I mean, I'd love to be able to show you this slide every time. It doesn't always happen like that, but this is what we're looking for, and I think it highlights how we sort of allocate to different specialties. We focus on macro, we outsource the micro, and in periods like this, we get contributions from both. We're pretty happy. So really, that was the only formal slide I wanted to share, I guess.
Can you go back to that just quickly?
Yep,
So I
sure,
just to
sure.
illustrate, because it's sometimes difficult to follow
Oh yeah,
the bouncing
I
ball there.
didn't share it. So the bottom
So
right-hand corner is kind
yeah,
of the bottom line, which is,
exactly. So the
yeah.
one, when you use the word effect, you do that intentionally as opposed to return. So the effect is your tilts drove an effect of 1.787% in total between manager selection and asset allocation effect. Can you equate that to return? How do
Yes,
you equate that?
yes, great question. I'm glad you asked that, and I think I've asked. Actually, we need to do a better job representing this because this really is that alpha or excess return. What about the beta, right? Because that'd be the first
Yeah.
question. Well, what does this mean in return? So these will be ballpark figures, but my guess is, the benchmark is around 8.5% year-to-date return through this period. It's probably even 9%, but our portfolio was significantly better, more like about 11%. So call it round numbers. If our benchmark's 9, we've done 11, you're looking for basically 2% or 200 basis points in effect. And that's effectively what we have there is that 187 basis points. So benchmark was 9. We were about 11 through this period. That's good value added from active management. Again, from a couple of different diversified sources. It wasn't just a bet on against bonds. It wasn't just a bet on growth equities. It was a number of individual ideas that worked out in concert to that overall effect. But it's a great point. Thanks for asking.
Okay. Okay, perfect. No, thanks for sharing that again. Okay, well, I'll just make a couple of final comments. If you can do the group shots, Stephen, that would be great. So if I had to sort of summarize just two, maybe three takeaways, is I do really appreciate Stephen's comments around that active's been it's been a challenging space to be in for a number of reasons, principally because central banks have been orchestrating an environment of almost zero interest rates, and there hasn't been the kind of volatility, that he's seen historically that active strategies can exploit the way they have historically. So we're transitioning into a period where active, in fact, may be a very, very important strategy to employ in portfolios as we see potentially more volatility and moving into a more normalized interest rate environment. So I think your overview, Stephen's great. Just to go over the mechanics, your perspective on the opportunities. Any final comments you'd like to make to us before we close out?
Well, I mean, stay invested. I think that's obviously my key message always. I mean,
Yeah.
we didn't think it was going to be a double-digit year necessarily in bonds, and we're doing this every day, so it's very difficult to time the market. But over time, hopefully, our tilts have added value, and the biggest thing is what you brought up at the outset, and that is don't lose faith in active management. I think now is the time for it to shine. We're seeing advantage or examples of that in the underlying strategies, in addition to the asset allocation alpha. Again, not always positive like that, but I think that volatility that we're likely to see, likely into this fall. I don't know, some big events happening apparently in November. I think we're going to see more volatility, and that's better environment for us active managers. So, and other than that, really appreciate your time today, and happy to field any questions that Shaun you may get from the field or any of your clients, and I'm always available. So I really appreciate it.
Yeah, no, thank you so much for your time. Thanks everyone on the webinar. Like I said, we are doing a recording. We'll get a follow-up out to you. And if you have any questions, don't hesitate to reach out to the office.
Well, it's my hope that you got a few nuggets from this conversation, maybe some comments provoked you to some reflection or thinking about your portfolio. Again, if you don't want to miss future content, interviews like this, or other content videos we create, make sure you subscribe to the channel. And like I said at the beginning, if you're within 5 years of retirement, be sure to go to our home page. You can find out how you can access a complimentary gap retirement analysis. The show notes contain a link back to our website. You take care. Bye-bye.